Okay, should we start?
Let's go.
First thing, I think I'm worried about. I want to tell everybody about a tweet that you put up recently. So we'll try to get it on the screen. But Sagar recently put up a tweet where I jokingly told him that you have a face for radio. And the next week he's got us on a podcast. And I'm not sure, he might just fire me on this podcast. But
This
anyway,
is just to prove a point.
that you have a face for podcasts.
Exactly. For TV.
This week, the company that we're sort of deep diving into is Northern Arc Capital. From what I understand is there's nothing wrong about it. It looks like a great company, but for some reason the stock hasn't performed well, right? So let's go right into it. Why?
Okay. So, firstly, Northern Arc Capital IPO'd somewhere in September 2024. Now, it's got a very vast background, but cut to the IPO, it was oversubscribed 117 times.
Okay.
And oversubscription on IPO is kind of proxy to saying that the company is good and the stock is about to perform well. That is general perception.
Right.
However, since September 24 till now, the stock is actually down since the IPO price.
Okay.
So despite a blockbuster IPO in terms of subscription, the stock's performance has been pretty dismal. So we're at a place where it's a great company, but is it a good stock?
Fair
That's
enough.
what we're going to answer today.
Fair enough. So I think let's set some context by maybe you giving everybody a little understanding of what Northern Arc Capital actually is. What does it do, etc., etc.
Yeah. So in short, Northern Arc Capital is a NBFC. That's the simplest way of putting across what this company is. It's a non-banking financial company.
Right.
Essentially, what they do is they give loans out to people who do not have easy access to loans or easy access to the banking system. That's why the business of NBFCs exists. NBFCs typically can borrow from large financial institutions, they can borrow from banks, they can borrow from various sources, and then disburse the loans further, either to, say, people from low income categories, to people in rural areas, to medium and small sized enterprises, MSMEs. So, wide category of people who need the money, but either who are not able to access the banking system or the banking system is too big for them.
Okay. So is it fair to say that sort of Northern Arc and the other NBFC sort of organizations target a tier 2, tier 3 strata of society?
Predominantly, yes. May not be entirely true. A lot of NBFCs are also focused on salaried employees. They offer affordable housing loans to people. They can be in tier 1 as well, but to say mid-sized loans or low-sized loans, even in tier 1.
Fair enough.
But yeah, largely, to put it very simply, it is for the underserved.
Understood, right? So essentially, I mean, what we can establish is that anybody who doesn't have access to the mainstream banking system sort of has an alternate option to get their loan or get their credit needs met, right?
Yeah.
Now, if we take another step forward, right? So everything that you've explained to me sounds great. From what I understand, this industry, NBFC as an industry or Northern Arc as an organization, is only going to keep growing. The market is going to keep growing. The need for this service is going to keep increasing. So what's gone wrong with the stock?
So, okay, so before stepping into that, there's a slightly different angle to Northern Arc as well.
Right.
It's not just an NBFC. So it has a total asset book of about 13 to 14,000 crores. Right. So it's lent to the extent of 13 or 14,000 crores. Only about half of it is from the NBFC.
Okay.
The other half is something that differentiates Northern Arc Capital. It's something. It's a business called. It's actually a capital enabler.
Okay.
Okay. So what it essentially does in this business is three things. Number one, it will lend money to people like itself. So other NBFCs or partners who have customers. Northern Arc will give them capital and they will further disburse it to others.
Right.
So that's one business. So they're not directly doing it to the customer.
Correct,
It is
correct.
not B2C, it is
B2B2C.
B2B2C.
Yeah, fair enough.
That's one part. Second part is they actually restructure and structure debt obligations.
Okay.
So I'll give you an example. This is something that Northern Arc actually pioneered in India. What it did is, imagine you are an NBFC, I am an NBFC, and there are two other NBFCs.
Right.
Right. All these have their own loan books.
Correct.
What Northern Arc did was they combined all these loans from different originators, the guys who are giving loans out.
Right.
Combined it, pooled it into one single asset,
Okay.
and then sold that entire asset to a third party.
Understood.
Right?
Understood.
So this is called securitization. Now, Northern Arc Capital is somebody who's the first one in India to have securitized loans from 4 different lenders into one single instrument.
Okay.
And the fact that it got sold out to a third party is testament to their ability and validity of this asset class being, say, valid and credible and workable.
Fair enough. So okay. I mean,
So sorry, that's the second business,
right.
and they have further nailed down on this. So now that they did this, they did several other transactions. They started placing these debt obligations, combining them, securitizing them, and then selling them. So that is now a legitimate business for them, which is a sizable portion.
Right.
So of the entire 14,000 crores, you got 7 or 7.5 that is loans disbursed directly as an NBFC. The other bit, a part of it is given to other NBFCs.
Right.
A part of it is where they're doing this capital enablement. And the third part is they actually manage debt assets.
Okay.
So like Paterson PMS has a PMS license.
Right.
Where we take assets, underlying assets are equity portfolios. These guys actually make portfolios out of debt.
Right.
So the loans are actually converted into debt instruments, which they take positions in through their asset management company. And that is the third part of the business.
Right.
So is it truly an NBFC? Not really. It started off as an NBFC.
But it's got sort of
Later-
3 different revenue models working simultaneously. Makes sense. So, I mean, all of this sounds good, right?
Yeah.
So, again, the same question arises, why is the stock not doing well?
Yeah. So the primary problem for this entire company has been something that is not a company specific problem. It is more of an industry problem. Now, NBFCs also, there are several categories that NBFCs lend to. It can be housing finance, it can be vehicle finance, it can be rural, it can be farmers, it can be anybody.
Right.
Vehicle financing, you can do a
Right.
lot of stuff under NBFCs. Now, there is one particular segment within NBFCs which is quite stressed at this point in time,
Okay.
or which has been over the last 1 year. This is called MFI.
Okay.
These are primarily called microfinance institutions.
Right.
As the name suggests, these are loans which are very small in ticket size.
Right.
Typically below 10,000, below 50,000 by definition, but they can be on average 7 to 10,000 or whatever.
Fair enough.
Now, these loans are, as you imagine, provided to people who are of slightly lower capacity to repay these loans
Right.
or of financial health.
Right.
They're a little crammed up on their finances.
Right.
So typically what happens is when and economies go through cycles, right? So sometimes when an economy is going through a slightly stressful cycle, this strata of society is usually
Gets
the one
affected
which
the
gets
most,
affected
yeah.
the most. Over the last year, this has been a little bit of a problematic area for the entire economy.
Right.
So it's not only Northern Arc, but anybody who has a sizable MFI business has been impacted by the latest cycle.
Right.
Now we're currently at a stage where things seem to be improving on the ground a little bit. We are seeing that there is some improvement in terms of delinquencies, NPAs are coming down, people are actually repaying their loans, the credit
Right.
cycle is moving slightly.
Right. Right.
So those green shoots, once they start appearing, is when there'll be some impact which is positive on the stock.
So just to interrupt here, so you're saying that the major stress on the company comes from delinquency of people being able to pay back their loans, which essentially happens due to tough economics or a recession or any kind of stress on their income or their businesses, right? And once that eases up, automatically the domino effect is where people start repaying the loans, the delinquency rates goes down, and naturally the company is in a better position. Is that fair to say?
Essentially. However, one point in that is that it can sometimes be a function of the cycle going down, but at times it's also a function of imprudent lending by the lender itself. So if you've been very aggressive in terms of growth,
Right.
and see, giving money out is easy.
Right.
Taking money back
is the challenge.
and earning something
True.
out of it is the challenging
True.
part, right? So sales teams usually have very nice targets and like
Right.
they say, oh, distribute 10,000.
No
crores.
background checks done,
Sure,
nothing.
I'll do it,
Yeah.
right? So that's where the problem usually happens.
Right.
And MFIs especially, because when it's low ticket size loans, sometimes the documentation is not present. These loans are usually without collateral.
Right.
If you're giving a loan to a farmer who's earning out of milking cows, for example,
Right.
and he wants to buy another cow, what is your collateral?
Correct.
And if he doesn't pay, are you going to get a cow back to your office? No,
Right.
it's not going to work out, right? So that's where this becomes a stressed area.
Right.
Now, out of the 7,000 crores that the company has in assets, which it has lent out, about roughly 1,000 crores is from rural.
Okay.
And over the last 1 year, this has actually come down from about a 1,400, 1,500 crores to a 1,000 crores. So the number has actually reduced. So this is where Northern Arc actually has been a little more proactive and said that if the cycle has gone bad and it's anyway a very high risk sector to be in, let's be a little prudent and cut down on this cycle and reduce the exposure. So MFI exposure was 33% of the total AUM last year.
Right.
It is now about 20% of the AUM.
Okay.
So, and in an NBFC, what usually happens is what is growth for an NBFC? The more
loans.
amount you lend, the higher the growth,
Right.
and the better the stock is expected to perform
Right,
because
right.
all those metrics flow down. But in this case, because they were trimming their book
Correct.
in a negative cycle, is why the stock has not done well.
Right. So the company essentially, from what I understand, is making prudent decisions, is sort of going on the right track. But because in the short term, the numbers and the number of loans disbursed, if I may call that, is reducing, and they're being a little more careful in terms of who these loans are disbursed to and trying to cut down the delinquency rates. That's why in the short term, right now, it's not looking as a good stock.
Yeah.
But the solution, so let's understand, right? Where do you see this stock in the years to come?
So, see, typically this stock is one where it started as something, it's added, it's innovated. Like the capital enablement part did not exist as a business. It was a
Right.
pure play NBFC at the beginning, right? These parts got added in later.
Right.
And now it is pretty well diversified. It's got 3-4 different revenue streams. Its exposure is pretty diversified. Overall, it has still managed to clock a 30% CAGR in terms of AUM growth over the last 10 years.
Okay.
So it is a brilliant number to have. Obviously, barring some hiccups which have been consistent for everybody, right? Which have been demonetization, COVID, bad MFI cycles, these come and go. But irrespective of that, if the company's clocked a 30% growth and has reached a 14,000 crore AUM number, it has performed really well in the past.
Right.
Now, what you have to look at is what it does in the future. And for this, the focus areas of the company are pretty simple. Rural is going to be contained at whatever it is right now. However, the focus areas are going to be consumer loans, which as a asset class is very well performing.
Right.
The other is MSME loans.
Right.
Right. And capital enablement, where the businesses of securitization of debt or managing debt PMS and stuff like that, that is a pure play asset management business.
Right.
That sort of somehow balances out the lending business.
Right.
So overall, if we look at it, what I'd look at in any NBFC is the portfolio diversified enough? Right. In this case, it seems to be. Number two, are they growing?
Which again, it seems to be. Yeah.
These guys have done a good job at. Number three, are they growing in a prudent manner or not? So if I look at the overall delinquency number, these guys have a GNPA of about 0.60.
So let's hold on. What's GNPA?
Gross net performing assets.
Okay.
Sorry, gross non-performing assets.
Right.
So that's at about 0.6%, which is again very low. Industry is at about 4%.
Correct.
So these guys have done a good job at making sure that they've lent properly and that money is actually going to come back to them.
Right.
So the stressed assets are relatively pretty low for this.
Correct.
Right. That's the other bit. Now, if these metrics are in place, more or less you're on track when it comes to growth. However, when we look at NBFCs, that's not the only thing to look at. At the end of it, you need to do it profitably.
Right.
So the very simple equation you want to look at is what is the yield that I'm getting from the money that I'm giving to people, right? On average, these guys get a yield of about 17%.
Okay.
So if I'm giving 100 rupees,
I'm getting 170,
right, including interest back, right? Obviously, NBFCs also have to source funds.
Right.
So there is a certain cost of funding involved.
Correct.
On average, these guys have a cost of funding of about 8.7%.
Right. So you're still looking at a profit of about 8.5-9%.
So sure, it comes to that, and then there is an operating expense as well.
Right.
Right. So on average, there's this number called net interest margin, NIMS.
Right.
For them, it's at about 9%.
Okay.
Okay. This is higher compared to other NBFCs, which would be at on average about 6-7%.
Right.
Banks at about 3-4%.
Right.
So these guys are doing actually a good job when it comes to operating profit metrics on whatever they're lending out.
Right.
The last bit that comes off when you want to look at an NBFC and whether it's going to perform well or not is return on assets and return on equity.
Right.
At the end of it, from a stocks perspective, if you're deploying a certain amount of capital in the form of equity, how much money are you earning for your shareholders?
Right.
Or on the assets that you're deploying.
Right.
Right. That's where these guys currently are doing an ROA of about 2.4% and ROE of about 9.3%. However, these guys have set out some 3-year targets.
Right.
Now, the 3-year target is that the ROA should go to about 3.7 to 4%.
Okay.
And the ROE should be between 16 and 18%.
Right.
So, all in all, to answer your question, if they manage to grow historically at what they've grown at, they manage to increase their operating margins or NIMS from here by either keeping costs low or by reducing the cost of funding. We can get into that, why that is likely to happen. And thirdly, if their return on assets and return on equity are good, then the stock should perform well.
Fair enough.
Sorry, let me correct that. Then the company should perform
well. Yeah.
Makes sense. So from a financial and sort of valuation perspective, how would you sort of rate NBFCs and especially Northern Arc?
Right. So Northern Arc at this point, if you look at the overall NBFC space, you can categorize all NBFCs into 3-4 different parts. There are ones which are very large premium NBFCs, which are stuff like your Bajaj Finance, which trade at a valuations for NBFCs is usually on a price to book value.
Okay.
Right. It's called a PB ratio. Now for premium ones, it goes to 2x, 4x price to book or even higher. Right. Then there are the mid-sized ones, which trade at about 1.5 to 2.5x. Small ones, which are at 0.8 to 1.5x. And then the distressed ones, which are below 1x. Right. That is usually how it stacks up.
Right.
Now, if I look at Northern Arc, its book value per share is about 219 at this point in time. Its share price is roughly 242.
Okay.
So it comes to about 1.1 times.
Right.
So it is slightly below it's in the small category, not distressed.
Right.
Is there potential for improvement? Yes. Now, how do we judge whether it can improve from here or not?
Right.
Right. So 2-3 things. One is if I look at someone like a Credit Access Grameen, that is another stock which is an NBFC stock that trades at a roughly 2 to 2.5 times price to book. The difference is that it's got a ROE of 20 to 25%.
Okay.
We are here in the mid-teens.
Right.
Right. ROA is at about 4 to 5%. And NIMs are at about 12 to 14%.
Right.
So what we have to look at when it comes to valuations is if Northern Arc is able to move its portfolio from where it is towards something which has these metrics and hence trades at 2 to 2.5 times, will the valuations gravitate towards that or not?
Yeah. Right.
Looking at the 3-year targets, which the company is given, we're targeting, the company is targeting about 4% ROA, 16 to 18% ROE. So lesser metrics, but definitely something that would go higher than what deserves a 1.1 times price to book.
Right. Makes sense. So overall, I think everything that you've spoken about, I think whatever conversation we've had, I don't see a single foot stepped wrong by Northern Arc so far, at least.
I mean, that depends, right? At the end of it, it also depends on how the cycle goes out.
Right.
So what we've seen in the MFI cycle is just some green shoots coming. But that cycle has to turn entirely for you to actually see it.
So how long is an entire cycle? How many? What kind of a time frame do you?
That can differ, to be honest. That can depend on what causes the cycle to turn in the first place. So that's a very tough one to answer. But at this point in time, what we see is that there are several initiatives done by the government, which is putting money directly in the hands of people in this segment.
Right.
Like there is the Jan Dhan Yojana. During elections, everybody was given money for all sorts of things. There is digital payments. There is a lot of stuff happening on the KYC front. RBI is strengthening norms. So all of these things lead to at least us believing that the worst is sort of over,
Right.
and that better days can be looked forward to. Additionally, there are tax cuts which are introduced by the government on direct taxes as well as GST.
GST, yeah.
So on both those fronts, we're expecting some amount of a revival in the rural economy.
Right.
If that happens, then you will see a revival in this cycle as well.
But so there's a lot of talk nowadays, and I might be going on a slightly different tangent. But there's a lot of talk nowadays about how the GST cuts or the GST revisions are set to sort of boost consumption in the coming few months, especially as India goes into its festive period of October, November, December, etc. But from a rural sector standpoint, does it have the same impact, or is this more of an urban phenomenon?
So I wouldn't call it. See, the dependence of rural only on GST will be lower compared to an urban, because rural economies tend to have much more multiple factors that are in play.
Right.
For example, is the monsoon good or not?
Correct.
How is the crop yield?
Right.
Even if the crop yield is good, what is the price they're getting on that crop?
Right.
So there are several factors that play into rural economics, which are very different from what urban economics.
Correct.
And putting all those together, where the monsoons have been pretty all right, they've been sufficient. There were early monsoons and whatever, but I think overall, if you mix up these 3-4 factors, things look pretty good from a rural standpoint. As far as turning the cycle is concerned.
Right.
Additionally, I think there are a couple of triggers for Northern Arc. It is not only this bit, because this is 20% of the AUM.
Right.
Right. I think a couple of other triggers for them is number one, the overall rate cut as well. So if you look at RBI cutting rates, usually what happens is it will also lead to lower cost of funding for Northern Arc itself, which we discussed is at about 9% or whatever. If that itself comes down, and the loans, because these are usually, if they're floating rate borrowings, so if that rate comes down, but the lending itself is done at a higher rate or a fixed rate, then there is a profit to be made from the spread.
Correct.
So something like this will play out for Northern Arc as well, which will be a good trigger, and which is why we've overall been pretty positive on the entire NBFC space so far. So that will also pay out pretty well for Northern Arc. So overall, while things look good from a long-term perspective, I think there are some couple of immediate triggers in the form of the cycle turning as well as the rate cycle, which are in favor as well.
Fair enough. So I think if you had to sort of summarize Northern Arc as a company, as a stock, for everybody listening, maybe a one-liner.
So we can't give a recommendation, obviously, but overall, great company. Hasn't been a good stock. Has the potential to be a good stock. It's just that a couple of triggers are required for it to turn into a good stock.
Perfect. Sounds great. And just like this, we're gonna sort of do a podcast every week. Every week is going to be a different stock, a different company, and we're sort of going to go deep dive into it, understand the numbers, understand what makes or breaks these companies and these stocks, right? Thank you so much for listening, guys. Okay, so let's start. This is a weekly podcast. It's called, what is it called? Taking Stock. It's called Taking Stock. How do we even begin, right? So Northern Arc Capital, from what I understand and the research that I have in front of me, is what I understand is a great company. Restart. Okay. Scrolling down the list.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.